There's a stock under $1 right now that the government keeps quietly signing contracts with. It's not crypto. It's not some meme ticker pumped on Reddit. It's not some startup that just raised money and is burning cash with no customers. It's an AI company doing something most investors have never even heard of. By the end of this video, you'll know exactly what it is, why some analysts think it could quadruple, and why other models think it could fall toward 50 cents. I'm not telling you the name yet, so stick with me. Let's start with what this company actually does, because it's not some vague AI disruption buzzword play. This company builds artificial intelligence that watches the road. Cameras mounted on highways and city streets feed into software that reads license plates, tracks vehicle patterns, and flags things in real time. That software gets sold to state transportation departments and police agencies, not retail customers. Not consumers downloading an app. Governments, writing checks, signing multi-year contracts. And that matters more than people realize because government contracts are sticky. Once a state agency builds its traffic infrastructure around a specific vendor's cameras and software, ripping it out and switching providers is expensive and slow. That creates a moat that's hard for a tiny competitor to break through. We're talking actual signed agreements here, not vague partnerships or press releases full of corporate buzzwords with nothing behind them. One state's district attorney's council just agreed in principle to work with this company. That's not hype. That's a check getting signed, and it's the kind of deal flow you want to see from a company operating in this space. Now let's talk numbers, because this is where it gets interesting for a stock trading under $1. Last year, this company brought in over $48 million in revenue. That's not a pre-revenue biotech burning cash on a dream. That's an actual operating business with actual customers paying actual invoices. And it's growing. Revenue increased year over year, and in their most recent quarter, revenue was up 12% compared to the same period last year. For a microcap stock, double-digit revenue growth is the kind of signal that often gets ignored simply because the share price has a decimal point in a place investors don't like. Gross margins also expanded to 53% in their latest quarter. That's a meaningful number because high gross margins usually mean the underlying business model, software, and recurring services is fundamentally healthy, even if the bottom line still shows losses. And speaking of recurring, 64% of this company's revenue is now recurring. That means the majority of their income isn't one-off contracts that disappear next quarter. It's subscription-like revenue that keeps coming in deal after deal, year after year. Management has even said they're targeting positive EBITDA by the end of this year. For a stock trading under $1, a real path to profitability is rare. Most penny stocks are praying for a miracle. This one has actual financial metrics moving in the right direction. Here's where this gets even more relevant to 2026 specifically. This same company has been developing privacy and data verification technology frameworks designed to protect personal data collected through vehicle recognition systems from being misused. Why does that matter right now? Because AI-generated fraud, deepfakes, and synthetic data manipulation are exploding as a problem in 2026. Governments and corporations are scrambling for trusted verification infrastructure systems that can say with confidence, this data is real, this video is authentic, this record hasn't been tampered with. Companies that already have government trust, existing infrastructure, and a head start on verification technology are sitting on a potential tailwind that most retail investors haven't even connected to the stock yet. That's the kind of asymmetric narrative that, if it plays out, could completely change how the market values this company. Okay, you've waited long enough. The ticker is REKR. Wrecker Systems, trading on the NASDAQ, currently under $1 a share. This is a real revenue-generating company. It is not a shell. It is not a pump-and-dump scheme with a stock promoter behind it. But I need you to understand something important right now, because what I'm about to tell you is just as critical as everything you just heard. And skipping it would make this video irresponsible. Let's start with the bull case because there is a real one here. At least one Wall Street analyst currently has a strong buy rating on this stock with a 12-month price target of $3. That's roughly 4 times where the stock sits today. The logic behind that target isn't complicated. If government contracts keep expanding, if margins keep improving, and if the company actually hits positive EBITDA like management is promising, a stock this small and this cheap can re-rate extremely fast. That's the multi-bagger setup people chase when they go looking for penny stocks in the first place. But now here's what nobody pumping this stock in a thumbnail with red arrows and rocket emojis is going to tell you. This company just missed earnings expectations and not by a small amount. Their loss per share came in significantly worse than what analysts were expecting for the quarter. It also recently diluted shareholders. The company sold millions of new shares in an offering priced at $1.75 per unit. Think about that for a second. That offering price is more than double where the stock trades today. Existing shareholders who held through that dilution watched their ownership stake shrink while new shares flooded the market. And there's a governance red flag too. The company's own annual shareholder meeting recently couldn't even reach a quorum. That meant no actual votes could happen on company business, and the meeting had to be rescheduled. That's not a deal breaker on its own. But it's the kind of detail that serious investors pay attention to and stock promoters conveniently leave out. Now let's talk technicals, because the chart is telling its own story right now. This stock is currently in a confirmed downtrend, trading below both its 50-day and 200-day moving averages. That's generally considered a bearish signal in technical analysis. And here's the part that should really make you pause. While one analyst has a $3 price target, certain algorithmic forecasting models are projecting this stock could actually fall toward 50 cents by the end of the year. That is the complete opposite outcome. So let that sink in. The real range of outcomes here is somewhere between a 4x move to the upside and a roughly 50% drop to the downside. And here's the honest truth. Nobody knows which one happens. Not me, not the analyst with the strong buy rating, not the algorithm predicting 50 cents. Anyone who tells you they know for certain is trying to sell you something. This is exactly why penny stocks are simultaneously the most exciting and the most dangerous corner of the entire stock market. The same volatility that can quadruple your money in a best-case scenario can wipe out half your position in a worst-case scenario, sometimes within the same month, sometimes within the same week. Companies trading under $1 live or die based on a few simple factors. Do they have enough cash to keep operating? How fast are they burning through that cash, and will they need to dilute shareholders again just to survive? Those three questions matter more than any hype video, including this one. So if you're genuinely interested in REKR after watching this, here's what I'd actually do before risking a single dollar. Pull up their most recent quarterly filing and look at their cash position. Calculate their burn rate. Ask yourself whether another dilutive offering is likely before their next earnings report, because that's exactly the kind of event that can crush a stock like this overnight. Look at insider buying, not just insider ownership. Look at whether institutional investors are accumulating shares or quietly exiting. None of that information is hidden. It's all public. It just takes more effort than watching a 30-second clip on social media promising you the next stock that's about to explode. That extra effort is the entire difference between gambling and investing. Gambling is buying a stock because a stranger on the internet showed you a green arrow. Investing is understanding the business, the risks, and the realistic range of outcomes before you ever click buy. I'm not a financial advisor, and nothing in this video is investment advice. This is research and publicly available information presented so you can form your own opinion, not a recommendation to buy or sell anything. Always do your own due diligence and never invest money you can't afford to lose, especially in a stock this volatile. If you want me to break down the next penny stock exactly like this, the real bull case, the real bear case, and the numbers nobody else shows you, hit subscribe. Drop the next ticker you want me to research in the comments, and I'll see you in the next one.